Okay, let's start it. Okay. Hi, so welcome back, and I think what we're discussing here is sound is there. Yes. So the point that we are addressing is, and we have changed the prices for the benefit of our participants. The prices have been a lot of values have been changed. So इसमें what we are trying to address is that call LTP and likewise for put LTP, it is sum total of your intrinsic value plus extrinsic value, which is some other factor. Okay. Now the point is, how do I know that the concept of extrinsic value exists? First, let's prove that point. If you look at this price, this price, you would realize that this is not equal to, so call LTP is not equal to extrinsic value. That means there is some extra factor needs to be added. And what that extra factor is known as extrinsic value, which has two components. So if you look at in terms of a diagram, if this is the price, so this is equal to this price, this component plus some other component, then becomes a full balloon, a bubble. So this extrinsic value has two components. One is time value, and then it is volatility. In this Excel sheet that comes from Sensible, so I think though, so two things, one, we should be thankful to them, because I would not have been able to teach in this way if this was not there. And we have done tremendous amount of plotting and all, which gives us a good insight into how options behave, at what levels, how premiums decay, how premiums change. It's a good, so we should not criticize that. But the problem is that here they give you only time value, which is this part. What about the other part, which is not there, which is what about the other part, which is not there, which is the volatility part, which is this one, that is not there. So what we will, the exercise that we'll do is, we have the LTP given, you have the intrinsic value given, okay, the time value is given, but in this both are included. Volatility is also included and time value is included. So we will split into two components. Using the Black-Scholes model formula, Black-Scholes model or Black-Scholes model formula, you will split this into two portions. One is the time value and second is the volatility portion. How will you do that? Because you have something known as IV, which is available to you. What all factors go into Black-Scholes formula when we study that? But just to tell you, the spot price goes into, what is spot price? It is Nifty now. Whenever in the world of finance you see a terminology or a word or a letter which has zero attached to it, that means now. Time zero. It is not T plus 1, it is not T plus 2, it is not T plus 3, it is time zero, which is time now. Understood? T0 means now. So spot zero means Nifty now, or Sensex now, or Index now, or Dow Jones now, or Kospi now, or FTSE now. That is one component. Second thing which goes into it is strike, which you have anyways seen. We've been discussing about the distance traveled. So that is strike. Then you have time, which is time to expiry, which is an extrinsic factor that we have discussed. Correct? Then what goes into it is risk-free rate of interest. Risk-free rate of interest, and the whole world is telling us that we should be taking RBI 10-year GSEC bond rate, whereas in the formula what is actually used is a 3-year short-term T-bill rate that the textbooks don't specify. That is where the practice and the bookish knowledge, these are two different things. This you will not find in the CFA book. They are not telling you, but on a practice basis, real basis, they are using MIBOR rates or RBI rates, GSEC rates, but that is T bill, not a T bond. It's a 3 months, less than 1 year. Okay, so that is one. This is an important input that I've just introduced in a basic class. It's a very basic class, but I've just introduced my input. So one is the risk free rate. Time to expiry आपने देख लिया. इसके अलावा एक और factor, there is another factor which is there, which is known as volatility, है ना, standard deviation. I know it does not look like a standard deviation, but that is how well you know how to draw and write. It's dependent on your writing skills, but it is volatility. So one more time, what all factors go into the Black-Scholes formula, है ना? To understand this, where does this come from? This comes from the Black-Scholes model, Black-Scholes-Merton formula. What are the factors? One more time, it is the spot zero, which is Nifty now. Then you have strike price. You have the time to expiry, which is always reducing. So time is a negative factor because it is always going negative. Right? Then you have the interest-free rate, and apart from this, you have standard deviation, which is built into this one. So what you have apart from this is standard deviation. These factors go into calculating the price that you see here. Right? Essentially, when you look at the formula is looking at two different things. Listen to it carefully. When you look at the Black-Scholes model formula, it is looking at what distance it travels, okay, between spot and strike for a call option, because it is moving upwards, for a call option, and for a put option, just the reverse. So let me explain only via call option. So what is the distance it is traveling and what is the probability of this happening? That is why Black-Scholes formula is important as compared to the other methodology, which only looked at call LTP is equal to the distance that you have traveled, which is spot minus strike, which is nothing but your intrinsic value. Understood? And some extrinsic factors. When you look at the traditional methodology before the Black-Scholes model, you were just looking at the spot minus strike kind of a thing. But why they won Nobel Prize, these three guys, Black-Scholes and Merton, why they won a Nobel Prize is because they introduced probability distribution into the prices. What is the probability that the spot will go above the strike in a case of a call, and the price, the spot will go below the strike in case of a put option. So they introduced probability ND curve, which is normal distribution curve. So when we look at the formula in the next class, you will see that there is ND1, if you remember the formula, and you will see that there is ND2 they are talking about. They are talking about essentially what is the probability that spot would be above strike for a call option, and for a put option, what is the probability that strike would be above the spot, and the probability of it, and hence ND1 and ND2. See, I am explaining from a very different angles. One is how far you run upside, that's intrinsic value perspective, and how far you run. But when you actually look in the markets, when you go to the market and pick up this number, you realize that this is not just equal to the distance, the magnitude it travels upside or downside. There is more to it. That more is the probability, and the probability of the time, and the probability or the feature of a time, or an extra feature which is given to you, which is time, and also the volatility. The Black-Scholes model takes it one step ahead and says, okay, I'm looking at this distance, but I'm also looking at what is the possibility that Nifty would travel up, spot will cross the hurdle rate, or the spot will fall below the hurdle rate in case of strike. Have you understood? This is Black-Scholes, and for this they were rewarded, but they did a classical mistake and they lost their entire capital, close to $2 billion, and the name of that company, their company was LTCM, long-term capital management, which became short-term in nature. They lost their entire capital, and today no college, no university has their photographs attached. In fact, you don't know the reason you are sitting here, the reason you hear about Indigo doing their risk management, Reliance doing their risk management, the story of the farmer that you spoke about. Every book has that farmer who uses put option for hedging, and every airline, every book across. I have read so many books. I have spent 1 full year sleeping in the library, not studying. 1 full year, 365 days in the library, and with master's book. So I knew all the books of Fabosi there. Fabosi has so many books on the bonds, like that. So when you refer to all the books, you would realize, and you could borrow. The US has such a good system. No matter how much you criticize, you can, sitting here, I can order a book which is lying anywhere in the US. It will come to me free of cost. Only when someone requests, I get an email, and then I have to send the book back. It's a book, national book library, which is running across the world. So I could order from any of the libraries free of cost. It gets delivered to my library. I pick it up from there. When I get someone requests it, I just have to go and deposit. Otherwise, there is a fine imposed by my library. Amazing library management system. So, every book that you refer to, they're just talking about the aviation company or the farmer. But I think these guys, and no library has their pictures. You hear about Albert Einstein. When I went to Oxford, one of the classrooms has a board, a green board where Albert Einstein has taught. So from Germany, he went to America, but he was always under surveillance. People thought he is a Marxist, he is a Russian guy, is Russian agent. So he was always under surveillance. Though he got his respect in America, I think he was teaching a pencil. So there is a board in Oxford University which says this is a room where Albert Einstein taught. Unfortunately, these three guys don't find any respect in the market. You know, people have forgotten about him, about them. It is because when you do a classical mistake, rather a universal, when you go against the universal principle of finance, you know, when you go against the universal principle, and whether it is a finance or whether it is of law, when you go against the universal principle, people wipe you off from the memory. They have a photograph, you can go and check. What was that universal principle? They had shorted naked put. Naked is just when you sell it and don't hedge it. So these are the guys who devised call first, then put options, and expecting something on the Russian economy, they had speculated. But it's not a naked. Naked means you have only taken one instrument. Either you have shorted a call or a put, but the other instrument is not there to cover the risk too. Like an insurance you have not bought. You are driving the car, but insurance is missed. So they were driving the car, and that to a fast car in a fast lane without an insurance. So world said, we forget you, है ना? चलिए, ये हो गया. Now let's come to the sensible thing. Why Black-Scholes is important? Because it is not about the formula. It is about the probability distribution. If you can go to the, just do an alt tab there. Okay. Now let us look at, so there are 2-3 questions that we are handling, then we will stop. The first question that we are handling is, when you change the strike price, what happens to the call LTP and obviously the put LTP? But we will discuss only one because otherwise it becomes too confusing. So what happens to the call LTP? When you change the time to expiry, okay, and not from a theoretical perspective, but from actual observation, what happens to the call LTP? When you change the IV, what happens to the call LTP? Okay? So these 3 exercises will do. It's a very good analytical tool and should be used only for analysis purpose. It should not be used for trading purposes because the data as per SEBI regulation is delayed, and what you see here may or may not result into actual profits or losses. So be very careful. People get this feeling when you start practicing on such platforms that you will always make money. That is what cautioned the SEBI. SEBI was not happy with it, and they said, let's delay the data here. So the data is delayed. So please, for God's sake, do not trade basis this. These are only analytical tools. So we are starting with a simple example. What is a simple example? And I will talk about this in detail. All the strategies are split into 4 categories. Okay? But I will split it into 2 categories. One is a directional, one is a non-directional. What is the meaning of this one? Quickly understand before we just handle the question that we just spoke about. Directional strategy means you have some view. The view could be the market is going up or the market is going down. So that's called a directional strategy. Non-directional strategy means the market is not going anywhere, it's just hovering in a tight range. So there are only two kinds of strategies on the planet. Either you have a view or there is absence of view. View regarding the markets will go up or the markets will go down. That's one directional. Or the markets will not go anywhere. That is the view. Okay? So when you say it is a bullish strategy, you are talking about directional. When you talk about bearish, it is again directional. When you say that it is not going anywhere, it is non-directional. And when you say I don't care whether it goes up or down and I still want to make money, it is non-directional. You don't have any affiliation, inclination, association with a direction. When you want to Nifty to move in a certain direction, then it is directional. When you want it to go up, you have a directional view. When you want it to go down, you have a directional view. When you want the market to consolidate, you have a non-directional view. When you don't care whether the market moves up or market moves down, you have a non-directional view. That is the thing for now. I mean, not get into inside into it. I mean, deeper into it. So this is you are buying a call option. It is, say for example, quoting at 161 rupees. Okay, it is quoting at 161 rupees. Okay, you have bought a call option. This is of 2nd June. The strike price is 23850. This is C. Okay, now let's change the this thing. What you call is, let's change the first of all strike price. So what is the price quoting right now? 161 dot. Hello, you can read this. Now let's change the strike. Sorry, the expiry. So here we go. Let's change the strike. Let's change the strike. क्या drama है? What happens? हाँ? क्या हुआ? क्या हो रहा है बताइए? Price is increasing. Markets are charging you premium for giving you more time. It's like someone is in ICU and is asking for this thing, more time, more facility, and the hospital is charging them money and saying, okay, if you give this amount, you can stay longer. So time does not come free of cost. You are getting more time. Earlier you had only 1 week of time. Your view may or may not come true. Now you have 2 weeks of time, and now in this case you have 3 weeks of time. You will have to pay premium on top of it, what you have paid already. For extra time, you will have to pay more premium on top of it for extra time. Have you understood this? Yes or no? You have seen it actually. You have done the inspection yourself. When you add more time, there are no free lunches. Market will charge a premium for that. For giving more time, there is more money being charged. You can always calculate the delta. If we started from, how much we started from? 195 rupees, and now you landed up at 372. 5 rupees here, so it becomes 200, and 172 rupees, so it becomes how much? And a mod of it, so it cannot be negative. So this is 172 rupees and 5, 270, 177, no? 177 rupees you are paying extra for asking more time, so that your view comes true. Your view is subject to the time. If I tell that take a bet on Nifty, but I only give you 1 second, you have less time, your view may or may not come. But if I give you 1 year, there is a possibility, very high possibility. So when the time increases, and don't look at other things here, when the time increases, let's say if I go back to this one, the 2nd June, okay, let me show you something. When I give you more time, my probability of winning increases, correct? The view is subject to time. If I give you more time, you will win, correct? Now see that. So POP means what? It's not plaster, is probability of purchase. ठीक है, अब आप नोटिस करना शुरू करो. मैं इसको रीसेट करूंगा. आई होप आई कैन कीप इट लाइक दिस. चलिए, कैन आई चेंज दिस? नो. कैन आई चेंज इट? बार बार चेंज। अब आप देखना, व्हाट इज द पीओपी? 35%, करेक्ट? डू यू एग्री, यस और नो? देख रहे हो ना आप, है ना? उसके बाद चेंज इट, सी दिस, देखिए कितना हो गया, मोर और लेस इट हैज रिमेन द सेम। ठीक है, अब दूसरा देखिए, तीसरा देखिए, ओए 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 ओए, हाँ तीसरा देखिए, ये देखो आप क्या हो गया पीओपी। अब देखो आप, ये देखो आप कितना हो गया, 36 हो गया। अब लास्ट एक्सरसाइज आप देख लो, अब जुलाई में कहीं चलते हैं, और ये देखिए आपका क्या हो गया, probability of profit has increased. So you have gained 2% probability just by changing the time. But this probability of winning, does it come free of cost? You have covered a distance of 195 to 631 और मिला कितना आपको, सिर्फ एडिशनल 2% probability which is again under 50%. कोई बच्चा भी टॉस करेगा तो he will have a probability of 50-50. A kid, if you give a 6 month kid and ask him or her to toss, when he tosses, the probability of profit available to him or her is 50%. That means, one, this probability is against you, and you have spent 3x more rupees to add 2% probability. This is not a favorable probability. This is stupidity actually. So that is what we work on. मतलब that is what traders work on, and that is what we train on. समझे आप? Have you understood this? Yes or no? It is all about probability of profit. So when you go far in time, you gain on the probability. Now it is a cost to benefit ratio analysis whether this probability is suitable or not for that amount that you pay. है ना? इनिशियली जब आपने देखा तो कितना प्राइस आपने पे किया था? फॉर 2 जून द प्राइस वाज ओनली 140 रुपीज। प्रोबेबिलिटी ऑफ प्रॉफिट कितनी है? इट इज 35%. नाउ आई हैव गॉन से टू 28 July, the price is 617, and how much I have picked up? Only 2%. Only 2% picked up, but 3x more money spent. Is it wisdom? No, because still the probability is under 50%. 50% that means you lose in majority of the cases. So this is not suitable. That's how we analyze. I'm telling you about any strategy or some trade or something. Have you understood? Yes or no? Now let's come back to this one. Look at the probability of profit. You are saying the market is at this level, and what is the probability of this crossing? Let's go farther. I am increasing the strike. So first case, the market is at this level, and you have chosen a strike which is at this level. This is spot and this is strike. Okay. Now let's take a case 2. The case 2 is where the markets are here, but you have picked up a strike. Let me represent this by S0. Let me represent this by S0. The strike is represented by K. Let me put it here, and let's say I have chosen a strike of 24,200. I am saying my view is bullish, and I will make the real money when the market goes about 24,000. More accelerated amount of money. Whether you make or not, it's not known. There is no surety, and majority of the people are losing. Those are the disclaimers that you need, and it's a risky instrument. It's like a nuclear energy in your hand, which can blast also. Now, what happens to my probability? My question is not about the price. I am all worried about in this class is the probability distribution. When I add more time, does my probability is in my favor or against my favor? And the money that I'm paying is, am I paying too much money for a small amount of probability? The second question is, what if I buy a 23,850 strike call level? What if I buy 24,200? So let's change this and see if my probability changes here. Let's see if it changes here, and if I can simply change this. Look at this one. Okay. Has my probability changed? Has it dropped or has it gone up? Why has it dropped? Because you're saying that market should cross this level in a scenario which is negative, in a scenario which is bearish, where Trump Baba exists, and every night you see 3 statements. I don't know which news article and which website to now trust. There's a trust issue now with the websites and the news that I hear. I am saying you have time only until 2nd of June, and you have to cross this hurdle for you to make real amount of money. the probability drops. The farther you travel in a small amount of time, your view travels farther. In 1 second, you have to go to Burj Khalifa. Is it possible? Not possible. So when I'm saying that, okay, let's go to 25,000, the probability of winning drops to, you would rather not do these kind of things, right? And this is what is leading to burn of capital. So it is strike spread is about probability of distribution. The time to expiry is about probability of distribution. Samjhe is not about the price. Now the third thing I wanted to show you is, where is this one? Is this crystal clear? Have you all of you understood what I'm trying to explain? Have you understood? Clear? Can I move to the next topic? I am not explaining other topics. I am not explaining you what is the maximum profit, what is time value, what is intrinsic. Ye sab I am not explaining this. Neither this. Your eyes should be just fixated on this one and the factors that I've explained, which is this one. I have explained strike to probability of profit, and I have explained expiry to probability. Okay. Now also check. Acha, one more thing, one exercise which is pending is, when you have, look at this one, when you go further ahead, how does the price change? How does the price change? So you go from 9 June, so this becomes 16 rupees. So if you add more time to yourself, give you a benefit, you will have to pay more. If you add more time to yourself, you'll have to pay. This is clear. So time and price are directly related. Okay. Now check this one. At 23, at 50, the price is 129. As you go farther, as you choose a more difficult level, the prices become cheaper and cheaper, because you raise the bar. You're saying within by 2nd of June I have to go farther. These are also known as OTM. I will talk about OTM, ITM later on. But this is working against you, correct? So the markets will reward you by dropping the prices. They'll say, okay, buy this cheap. Market band hone wala hai. The sabji has expired. If you go to the sabji mandi or to the market yard at 8:30, the veggie is selling cheap. The prices have dropped because you are willing to buy the leftover. Likewise, borrow that example. When you are saying that I will choose a level which markets will possibly not cross, then your prices drop. So you have sacrificed something in terms of you've taken higher risk. Markets will reward you by dropping the prices. So this is a balance between risk and reward. So you have to always think, what have you gained, versus what have you risked. Understood? It's always balances. Now, so you have seen these two things. Now, the final thing, which is the most important thing, is this one. Let's reset this. So I will simply press the reset button. We have the latest thing. Let's reset this. Okay, इसको देख लीजिए, reset कर लीजिए. Fine. Now the problem at hand is, ठीक है? The problem at hand is that we are trying to solve is, ठीक है? मार्केट में अचानक से वोलेटिलिटी आ गई, वॉर हो गया, Israel war starts, Israel attacks unfortunately, Iran attacks unfortunately, Trump says something unfortunately, or something happens in our neighborhood unfortunately. What would be the impact on the prices? Okay, what would be the impact on the prices? The prices right now, and don't bother about this one, the prices something. So we are only bothered about this one, and look at this. So you have to look at the target price. This is call option of by nature. Forget about PNL channel, किसी के पैसे बन नहीं रहे यहाँ पे. So target price, this is the buying price, and what is the impact on this price? And I will change this letter or this word or this terminology which is known as V. The moment in a derivatives class you see V, you should think of volatility. Now it is correct. And volatility, if you look carefully, if you just turn it around, it looks like this. Correct? ऐसे घुमा दिया, this was turned. That means the prices can travel upwards or the prices can travel down. Meaning what? When you say 13.9 IV, that means the market, the Nifty can travel 13% upward or it can travel 13% down. It is not about a single side probability. It is not a probability of upside. It is not a probability of downside. It is a probability of upside or downside. Volatility has no sign, has no color. Okay? Second thing is, listen to this carefully. This is very important. This is annualized volatility calculated over the next 252 days or 365 days. Some places they calculate 252 days, some places they calculate 365 days. Why? That I'll explain in the next lecture. That is very important. People are not aware. If you are going to play around with the formula, the model itself, then you should know which thing, what is calculated on which basis. So this is either 252 or 365. In India, usually we follow 365, but there are different thoughts around which you need to know which days. Why 252 globally? Because that is the number of holidays you exclude and national holidays you exclude. Globally, people work around 250 odd days if you don't take extra holidays. This is the total number of time that sun takes to rotate around. Okay? So when you are looking at 13.9, it is not 13.9, it is 13.9%. It is not in a single day. It is spread over 1 year. Depends how you define the next 1 year as, whether 252 days or 365 days, and it is forecasted. So Nifty is expected to go up this from here by 13.9% in the next 1 year, upside or downside. That is the meaning of it. But our idea today is understand how the prices, this price will change, how this price will change if volatility increases. So welcome to the club of volatility. Let me show this to you. Now let's see if I can do this. I think this is, just wanted to click here, check this one and check the target price, and let me see if I can. One last try and then see if it works. I want this to be highlighted. I want this to be highlighted. See how it changes. Clear the content. Change. Let it go. See this? Do you see this? What is happening to the target price when the volatility is increasing? Do you notice? Yes or no? I'm talking about this one. Do you see what is happening? Yes or no? Do you see when the is increasing, what is happening to this column? Okay. Now that is about a call option. Listen to it carefully. The last sentence, then we are free to go away. This is about a call option. When the volatility increased, the price of the call option went from 160 odd rupees to 344 odd rupees. Do you confirm to this observation and the evidence that I have just presented? Yes or no? Do you confirm to this one? I can reset this and I can just take it back and see what is happening to this price here. Do you agree? Yes or no? With volatility, the price will increase. Okay? And with volatility going down, the prices would decrease. Check this one. We are going down on the volatility curve, downside. The volatility is decreasing. And I can go negative also. Negative means the volatility as compared to yesterday. This is zero volatility, but reset I can do minus 10. Now, let's say this is about the call price here. This is only call in this example. What if I select both a call and a put? Call and put. Now see what happens to the price. Are you ready for this exercise? The volatility is 14%. I have selected a call option and a put option also, and I am increasing the volatility. I am like a thrust होता है ना, प्लेन में बैठते हो आप, है ना, प्लेन के अंदर वो थ्रस्ट देता है ना, वो थ्रॉटल जो होता है, I'm giving the throttle now and see what happens. What I'm trying to help you realize, not memorize, realize and visualize, because people get into the habit of memorizing this and hence it becomes difficult. CFA level 1-2 पूरा याद करने में निकल जाता है because we never visualize कि हमें पता ही नहीं कि होता क्या है, कहाँ जाके ढूंढना है. Now see what happens. I will increase the volatility and see what happens to the call prices and also to the put prices. ठीक है, and then we'll go reverse on the volatility. ये देखिए, exactly that is what I need you to realize. क्या हो रहा बताइए? Exactly. You realize that you never mugged it up. It's not mugging up. You realized that when you increase the volatility, both call and put prices increase. Remember this one. ये visualize ये गलत नहीं है because this is, you know, Zerodha has made an investment in this one, so this is cannot be wrong. थोड़ा बहुत इधर उधर calculation could go off track and then they can do, but yeah, this factor is not wrong. Why that happens is, remember what I said about volatility. When volatility increases, the possibility of markets climbing up for the call guys increases, and the volatility for the put guys who are expecting the markets to go down, volatility is never one-sided. It could be both-sided. ठीक है, इस पे मैंने एक फिर theory float की, because when I train people who are already at advanced level, तो मैंने एक theory float किया कि volatility is of two kind. It is not defined anywhere. Volatility is of two kind. One is directional volatility, बहुत मुश्किल है यार, ठीक है ना, while you're speaking you're okay, done, okay. Well, volatility, so I floated my own theory because it becomes easier to teach. Volatility is of two kinds. One is directional, है ना? Now I am going away from my own definition. I told you that it has no sign, no color, becomes difficult to teach. Then I floated another theory. Volatility is of two kinds. One is directional and second is non-directional. ठीक है? Now how? When it is directional, it will either push Nifty up or it will push Nifty down, or any asset class. है ना? It could be any asset class, gold prices, ETF. But when it is non-directional, listen to it carefully. Introducing the main point of that last 30-40 minutes of energy sinking in it. It takes about 10 minutes to get you in the class, 30 minutes to reach here and then deliver something important. So it's a 40 minutes effort in any 1.5 hour class to train you. The non-directional also means, because when I am training, it presents another challenge. The challenge I will talk about later. Volatility then becomes of some, there is another category of volatility, which is what we call, which you will hear on CNBC, it is choppiness. It is not moving anywhere. Goes up, falls down, recovers. That also is volatility. And sometimes you have seen, for example, 4th of June, you have seen 2024. Lot of places you'll see it is not going in unidirectional. It is not going up. It is not going down. It is just hovering here. 400 points up in 1 hour, then falls 400 points. Is this not volatility? Yes, it is volatility. And why we had to define this kind of it? Post 2023, we had lot of HFTs into our markets, and especially a guy which SEBI investigated. It was becoming difficult to understand volatility. We'll just go up 30 minutes. It is like 200 points up, 300 points up. It will take an entire day. Listen to it carefully. It will take an entire day to travel 200 points. But here, because of some HFT guys, just in 30-40 minutes, 1 hour, it will shoot up 200 points or 300 points. Then all of a sudden it will drop. Now, what is this kind of volatility? It is non-directional, क्योंकि आप मिला जुला के वहीं पहुंच गए. It is नील बटा सन्नाटा. You show market ऐसे था, फिर अचानक से volatility आई, आप यहाँ आ गए और फिर इतनी तेजी से गिरा that you come back here. Is this volatility? Yes, 100% yes. It adds to theta decay. I'm just introducing a technical term so that you know that it relates to something bigger concept also. When you have this kind of a theta decay, the straddle prices decay even faster. But अब आपको ये सब समझेगा नहीं because you don't know what is straddle price, what is theta. But I've just introduced there are sometimes you have to throw a bouncer and a googly in the class so you know that okay, something nice is coming. There is bigger. Next step. Ah, good. But theta decay, then you'll understand. So the point that I'm trying to prove here is volatility is of two kinds. When you have this kind of clarity, then explanation in the class becomes easy. When you're training that on, otherwise it is always confusing. You are saying on one hand that volatility has no direction. All I'm saying is when it is 14%, we don't know this is whether it will take you 14% up or whether it will take you 14% down. And you have another kind of volatility which will take you 14% up and then bring you 14% annualized basis. This is not a single day volatility. Single day volatility, because you are master students, single day volatility is calculated by root of 365, which is nothing but 56% divided by 19.10. Simple Vedic maths. If this is greater than 1, so this volatility is going, this number is going to be greater than 1. If you have, say, this number called 18 here, you know that this is going to be less than. That's how you mentally map. This is very important. So this is about volatility distribution and this is about this distribution. So now you have seen that when volatility increases, both call and put prices increase. Do you agree? Yes or no? Look at this one also. You know, when it is going down, teaching is another problem in the digital world. हालांकि चीज वो कैमरा सेट करना 10 मिनट लगते हैं. It's not simple. But despite all the challenges, we never stop. Increase. Both. If volatility increases, both call and put. And then when volatility, बताता हूँ. उसमें क्या है ना, थीटा एक्सेलरेट हो जाएगा, तो थोड़ा सा उसको विल पार्क दैट क्वेश्चन. It's a very good question. Listen to it. It's a very good question. He's saying that the volatility is increasing both sides. It goes up and then and then so one is a bullish directional. 30 minutes the market moves in one direction, and then all of a sudden volatility comes, even more volatility, but this time it pushes the volatility down. So those scenarios we will investigate. Let's park those questions because it is a question of not call and put prices. See, matured participants don't see it from call prices or put prices only. They see it from the summation of call and put prices. So I will show you the straddle prices when it was choppy market and when it was directional bullish and then directional bullish. So when we will come to straddle, we'll handle this question. So this is a very important question. We're not skipping the question, but you have to understand, because matured participants are not looking at directional. Majority of the world is playing where? Non-directional. Which direction it goes, we don't care. ठीक है. But now अभी एक चीज और देख लीजिए, उसी में एक और एंगल है. There is a spanner in the problem. The problem is, which I will show it to you sometime later because it's getting closer to the lunch. Abhi what we have done is we have changed only one factor. Your question originates from where? I was just coming to that. So this is an advanced question that we're asking. The basic layer originates from something else. The question has an undertone or an undercurrent that is, which we'll solve in the next class, that, sir, we have only changed one factor and we are trying to look at the call and the put prices. You have not changed the Nifty. How can Nifty be fixated at one place? If volatility comes, Nifty will move somewhere, no? So in the next exercise, we will also drag it here. We will also drag it this side and see what happens to call and put prices. Then it is a 30-minute exercise, because you'll have to realize with inflated IV, expanded IV, exploded IV, what happens when the market goes this side, what happens to call and put prices, versus when the IV has not exploded, when the volatility has not expanded, when you just move the IV right side, when you move Nifty right side, when the Nifty goes up. So it's a comparative with and without IV explosion. When Nifty moves up, that means you take the higher numbers. This is, say, fixed. and then you move this number, then what happens to the prices of call and put? This is increasing, and this has already increased, and now this is moving, markets are moving. So it's a two exercise. Likewise, normal IV and market drops. What happens to call and put prices? Question number 2, 2A. This goes to 50%. This increase shoots up all of a sudden. This maybe increases to some large number, 20%, 30%, 50%, whichever number is there. And then you drop the markets. Then what happens to call? So it has 4 layers. It will take about 30-40 minutes to explain one scenario, which is very important. So that is coming next, because if I explain right now, it will be like rushing through the topic, which is not does not justify. It takes 8 hours to just run through this, another 8 hours to run through another topic. So 16 hours minimum you require to understand basics, and 16 plus 16 hours you require to understand the advanced. So it's a 32-hour effort. It will need about 30-40. Yes. हाँ, correct. हाँ, मैं आपको थोड़ा सा इनपुट दे देता हूँ. आई थिंक पॉसिबली विथ योर लेवल ऑफ अंडरस्टैंडिंग इसको देख लीजिएगा. आई जस्ट वांट टू गो टू द नोट पैड, है ना. इम्पैक्ट समझाता हूँ, फिर आई विल विजुअलाइजेशन आई विल शो यू द लास्ट कंसेप्ट. ये ओके टू स्टे लिटिल बिट इंपॉर्टेंट. ठीक है, ये देखिए नॉर्मल आईवी. What is normal IV? There is no normal or abnormal IV, but from the interaction over the few weeks, you will understand what is the idea of my normal. When I am teaching you implied versus RV, you will understand when I say IV, what is the sense. So say it is at 14%. Okay. So what is the call price? Maybe say right now the call and the put price of this. Visualization teaching. I'm not talking in terms of numbers. Okay. उसके बाद then, and the market is flattish right now. So market is hovering like this. So more or less both the call price and put prices are equivalent. That is what happens at ATM. You will see that this is 100 rupees, this is 100 rupees. Sum total is usually between 150 to 200 rupees. तो ये 50 होगा, वो 100 होगा, 150, 200, मतलब मोटा मोटी आप समझो कि same prices right now. Then what happens is, say the IV shoots up to 30%. ठीक है? Without market moving. That can happen if someone is manipulating the market. That also is. We have seen all shades. So this will, then this will become, let us assume, even if there is no market manipulation, because it's not easy to manipulate and then the regulator is checking, but sometimes we see the market is not moving, IV explodes and the prices are decaying. So all sorts of combination. It's not market manipulation necessarily. It's all sorts of probability distribution of prices which we have seen. So I would like to correct myself where I said markets are manipulated. I don't think it's manipulated. So when the IV expands, then you will see both the call and put prices. And I just want to draw an equal circle here. ये अंडा इक्वल होना चाहिए. More or less it is the same. ठीक है, ये दोनों भी सेम है और ये दोनों सेम. In both the conditions we have seen that markets have not moved. We have fixed one factor. Now let's move the markets. ठीक है, अब क्या होगा? अब market starts moving in one direction. Say market start moving upside. ठीक है, with this level of thing, तो होना क्या चाहिए था? Exactly, होना क्या चाहिए था कि ये होना चाहिए था कि आपके your call prices should have expanded. Your call prices should have expanded and this should have shrunk, because there is an inverse relation. Market is moving up, so call prices naturally will become bigger and the put prices will become smaller. Correct? Lekin the introduction is, if this is at 30%, this is the shrinkage. When you have एक मिनट दिखा दीजिए मुझे. When you have this kind of a shrinkage with 30%, the shrinkage is this much. If this shrinkage becomes, मान लीजिए ये drop होके 14% पे आ जाए. If this drops to 14%, ठीक है, so this may or may remain the same. This will become much smaller. So what it does is, IV does is like a balloon, helium balloon. You are pumping an air into it. वो थोड़ा ही छोटा होगा, but this will drink because the markets are against you. There are two factors in inflating this. There are two factors that are inflating this balloon. One is the direction. Is direction working in your favor? In this case, the direction is working. The market keeps on moving up, and it's you're talking about call option. But what is not working is the second factor which works in the favor is IV. When IV is at elevated level, what will happen is this will not shrink too much. It is keeping. Drop this to from 30%, it drops to 14%. Immediately, this one will shrink from this to this. Okay? Drop this further to 7%. Market keeps moving up, but volatility keeps dropping. Market keeps moving up, so this will slightly become bigger, not very big, and this will shrink even further. Market keeps moving up. Now add volatility. It's like a pump. Cycle में pump डालते हो ना? Think of that pumping thing. What will happen is this will get inflated further, and this will inflate further. Even though the market is working against put direction, but it's like pumping up the air. It is blowing air into the cycle tire, or in this one, it keeps growing and growing. The market is working against put direction. Markets are going up. Put should have declined, but it will decline at a slower pace because there is some other factor which is pushing it outwards. एक उसको अंदर ऐसे दबा रहा है और दूसरा अंदर से बाहर पुश कर रहा है. समझे आप? Have you? I hope you understood. So I'll show you 4 case studies with screenshots, then you'll understand. IV elevated, normal IV, elevated IV, markets going up, markets remaining same, markets going up, normal IV. मतलब 3-4 cases, I think there are 4 or at least 4 to 6 cases that come out of it. When you see the prices, then you'll visualize. But all I can tell you, market is working against you, but IV keeps expanding. The prices will not decline, even if the direction is against. And vice versa for put option. समझा आपको? Have you understood? पक्का? Can you tell me? हाँ, थोड़ा ऊपर से आ रहा है. हाँ, वो ऊपर से जाने वाली चीज है. All I am saying is, when IV increases, goes from 14% to 20% to 30%, ठीक? Both call and put prices will start inflating. That is clear. Right? This is C. This price will become bigger and bigger and bigger. That is what I was trying to show you. The put prices will also become bigger and bigger and bigger. This is put price. Now add a direction to it. So this will become bigger, even bigger, and maybe it was here, it will just come here. Reduce the volatility, then it will shrink faster. 14% पे इसका भाव इतना होगा, है ना? मार्केट आपके अगेंस्ट जा रहा है. 30% IV पे, 50% IV पे आपका पुट ऑप्शन बड़ा हो जाता है, even though directional is going against you. So the prices don't decline that way. And when you see the screenshots, you'll understand. Impact is less, damage is less, theta decay is less. Theta decay is less. It's like so IV inflates both call and put prices, and direction deflates or inflates depending on the direction. तो दो फोर्सेस वर्क कर रही हैं. अगर दोनों आपके साथ काम कर रहा है, मार्केट भी ऊपर जा रहा है, IV also, so it will start exploding. बड़ा हो जाएगा बलून. छोटा बलून इतना, it will become that big. And in this case, what will happen is one force is pushing it outside, the other force is putting it downside. तो कम shrink होगा. और IV हटा दीजिए तो फटाक से shrink हो जाएगा. Then this factor is not working, है ना? Inside factor which was supporting it is not there, तो shrink quickly. तो आपको मार्केट डायरेक्शन देखे तो केस स्टडीज आप देखो समझ जाए. वो आगे के लिए छोड़ते हैं, अभी आप उसमें डोंट गेट इनटू, बिकॉज वो फिर मैं जब आपको स्ट्रैडल के अलग अलग केसेस दिखाऊंगा ना, कि जब ऐसे ऐसे गया मार्केट, ऊपर ऊपर गया तो स्ट्रैडल का भाव क्या हुआ, फिर नीचे नीचे नहीं आया तो स्ट्रैडल क्या हुआ, फिर चौपी था, तो वो सब केस स्टडीज हैं. मैंने शो यू लॉट. ईरान वॉर में क्या हुआ, 7th of October था, इसराइल वॉर में क्या हुआ, रशिया यूक्रेन वॉर में प्राइसेस क्या थे. दीज आर कैन ओनली बी एक्सप्लेन वाया केस स्टडीज, अदरवाइज बिकम्स अ स्टोरी. तो वो स्टोरी तो आप याद नहीं. फिर इसके बाद हमने क्या किया, वी हैव स्टार्टेड वीडियो स्टोरीज. वी आर कन्वर्टिंग ऑल दीज कॉम्प्लेक्स स्टोरीज इनटू इंस्टाग्राम का हमने प्रीमियम लॉन्च किया है, विच इज अबाउट $30 और समथिंग, एंड दोज आर इन टर्म्स ऑफ स्टोरीज. किसी को नंबर्स नहीं समझता, ग्रीक नहीं समझता, गामा नहीं समझता, देन ही विल लिसन टू दिस वन, दैट ऑन दैट पर्टिकुलर, दैट इज हाउ द ट्रैप फॉर्म. सो वी हैव लॉन्च्ड अ वीडियो स्टोरी. ठीक, समझ गए आप? कैन आई स्टॉप दिस नाउ? Been speaking too long and I think I also feel exhausted.